franchisee accounting. So, if you are McDonald's, I don't want to use McDonald's anymore. I haven't eaten McDonald's in years. All right, let's use Taco Bell, good old Taco Bell. I'm pretty sure they're franchised, but doesn't matter. Even if they aren't, doesn't matter. Let's say they're franchised, and you've got corporate, and they don't really own any of the Taco Bell locations, and they just basically lease out the franchise, the intangible asset, to little individuals who want to start their own little Taco Bell stores, and they get the right to create one. And those franchise agreements are intangible assets. Those are valuable because you have the right to start a Taco Bell and make money with it. Or Dunkin', Dunkin' Donuts, that's another one. Dunkin' is a great example of that as well, because the company itself doesn't really own much in terms of their stores, but they don't bring in revenue from selling coffee or donuts. They bring in revenue from all these franchise agreements. So if you looked at their balance sheet and income statement, you would see a lot different than a company that owns all of its locations. So what do we do with the initial franchise fees? Well, the present value of the amount paid or to be paid by a franchisee is recorded as an intangible asset, like we said, that agreement, on the balance sheet and amortized over the expected period of benefit of the franchise. So the expected life of the franchise. If I buy a 20-year franchise from Dunkin' Donuts, that is going to be a intangible asset over 20 years, amortized for that period, and treated on the balance sheet as my franchise agreement. Now, continuing franchise fees received for ongoing services provided by the franchisor to the franchisee. These are franchise. Gosh, I don't want to say the word. I don't want to say French anymore. Franchise. It's getting old. Royalties, right? So like I was saying, Dunkin', the company, is going to just collect royalties. They're going to collect a bunch of royalty income. They're not going to collect income from sales. Usually, fees are calculated based on a percentage of franchise revenues. You'll see, okay, when I buy a franchise agreement to run a Dunkin', I gave up on the Taco Bell example. It's the morning right now, so I don't want to think about Taco Bell. I'd much rather think about nice iced or hot coffee at the moment. These are based on a percentage, so maybe 7.5% of all sales is given to the corporate overlords over at Dunkin', right? Services might include management, training, promotion, legal assistance, and that is what corporate is going to provide, right? Another example is Subway. Subway, why would you franchise a Subway? Well, you get the benefit of that brand recognition. You get management training from corporate. You get promotion, right? So they universally across the world, I guess they're around the world, promoted the $5 footlong. Now, that was definitely harmful because they definitely made these individual franchise stores sell sandwiches at prices that were detrimental to them. But, so it could be a pro or con. That is what you take into account when you were possibly going to franchise a store. And legal assistance, right? Now, together, individually, all these individuals are weak, but together, as a big entity, grouped together, they help each other out and they fend off those pesky lawsuits, right? Fees should be reported by the franchisee as an expense and as revenue by the franchisor in the period incurred. A little bit about franchise accounting. It's interesting. I definitely believe it is interesting. Will you see it much on the exam? I'd say not too much. I mean, you definitely could see it, but understanding this for sure is important, because if you don't understand it and you see any sort of question about it, you'll be at a loss.